What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown. Recently, the chair of the Federal Reserve, Jerome Powell, said that they are not seeking inflation that is substantially more than 2% or seeking inflation that is more than 2% for a prolonged period. Unfortunately, these words are chosen intentionally and specifically because they are vague and have no definition attached to them. So who knows what substantially or prolonged means? Further than that, Powell reiterated that they have the tools to put a lid on inflation should the need arise. So what we are going to talk about in this video is number one, is that true? Does the Federal Reserve actually have the tools, the capability to put the genie back in the bottle if they so choose to, if they would like to? And number two, if they do actually possess those tools, what happens if they try to use them? Ready? Let's dive in. So recently, Powell indicated that they are not seeking substantially higher inflation or for a prolonged period inflation above 2%. But like I said, there is no real definition to those terms. What they mean by that could be that, 3% is too high or 4% is too high, or maybe they mean 10% is too high. We don't know what they mean that they're saying, hey, we don't want it substantially over 2%. We also don't know what they mean by prolonged. Does that mean 2 years? Does that mean 5 years? Does that mean 10 years? There's no hard definitions to what this means. Basically, it gives them the wiggle room to say, hey, we're responsible, just trust us, without actually providing any sort of metrics to the public so that they can be held accountable to whether they're actually able to achieve what they say they're trying to achieve or not. Now, this comes at a time as everybody is now expecting that inflation is going to, at least temporarily, that's what the Federal Reserve says, it's going to be transitory. Everybody expects that inflation is going to be higher this year. And we're already starting to see that in places all over the economy, especially severe inflation in places like wood, commodities, asset prices, and even things like beef. And so it seems like they're running interference here and trying to get out in front of the news and say, hey, we were expecting this, but they obviously aren't taking the responsibility for themselves. They're saying, hey, this inflation is not due to any irresponsible monetary or fiscal policy. This inflation is due to supply constraints and reopening and regrowth. And they're following the classic central banker playbook. There's always another reason that you can look to and say, hey, that's the reason for the economic crisis. That's the reason for the destruction. That's the reason for the hyperinflation or the high inflation. It has nothing to do with our bad policies. In the 70s, it was predatory price gouging. Not the fact that we completely opened up the fire hose and removed any constraints on monetary creation. That obviously had nothing to do with it. And further than that, let's say they do want to try and put a lid on inflation. Number one, they're saying that none of their goals are going to be reached for years. And so they're moving forward with current policy for at least a couple of years. They're fully committed to their dual mandate, which is full employment and stable prices. And at this point, it's not just consumer prices. They're fully committed to stable prices of asset markets. Just look at how fast the Federal Reserve reversed course and changed their actions in light of credit market disruptions and stock market crashes like the one at the end of 2018 and the one at the beginning of 2020. So it's not just the prices of goods and services that they're seeking stability on. And when they mean stability, they mean consistently rising. And their other mandate, full employment, they actually have zero control over that whatsoever. The correlation or the statistical significance between monetary policy and employment is zero. They have no control over it whatsoever. So here's the real question. Let's say inflation hits 10%. 15%. The Federal Reserve looks at this and they say, hey, this is too high. We want to put a lid on inflation and we want to push this back down. Do they have the tools to put the inflation genie back in the bottle? Can they put the toothpaste back into the tube? The answer is actually yes. Instead of purchasing $120 billion worth of assets every single month, both treasuries and mortgage-backed securities, they would have to reverse that and start selling assets into the market. You might be asking, why would that have any effect on inflation or deflation? Well, it's because that's the exact opposite of what they're doing right now, which is causing inflation. They'd also have to release control of interest rates and allow the market to determine from the full short end of the spectrum all the way to the long end what the proper interest rate should be through the simple buying and selling of the assets that are hitting the market. And the market would speak and rates would skyrocket. See, the reason why they're doing what they're doing right now is because they're injecting money into the economy by buying these assets. In coordination with fiscal policy, in coordination with the Treasury issuing these bonds, this is newly created money entering into the economy. There is total monetary expansion happening as a result of the Federal Reserve creating money out of thin air to purchase bonds from banks and primary dealers who are purchasing those from the Treasury. And that adds money to the base layer of the banking system that has a multiplying effect by creating money throughout the rest, broad money throughout the rest of the system. And so the only thing that they would have to do is reverse course. If they start selling assets into the market, that means the market is buying those assets from the Fed. If that happens, money is now leaving the system and going to the Fed where it's destroyed. It exits the monetary system. The total supply of money starts to drop. Further than that, the amount of money that the Federal Reserve is spending on assets right now is keeping asset prices high, which for debt keeps interest rates low. That means when they reverse course, the supply of debt hits the market that just skyrockets. There's a lot more debt being sold onto the market. That means that there's more compared to the same demand for that debt right now, which plummets the prices of that debt. When debt prices go down, interest rates go up, which itself has a very powerful effect on the economy and on inflation or deflation, because if interest rates start to go up, the economy, corporate America, can't roll over its debt as effectively anymore. If corporate America can't roll over its debt, all of a sudden, it can't afford to pay its bills. Same thing would happen with local and federal governments. If they can't pay their bills, they have to cut costs, cut expenses, or go bankrupt. When companies go bankrupt, all of that wealth that was paper wealth that was there before evaporates. It's no longer a liquid asset. It can be no longer sold in order to produce money, produce cash. So that's real deflation taking place. When businesses and people, because of higher interest rates, cut down on their spending, that hurts revenues, that hurts incomes across the board, because one person's expense is another person's income. And so incomes start to drop across the board. And when incomes start to drop across the board, that makes it even harder to pay your bills. And you can see now why it's called a deflationary death spiral. It's because for thousands of years, anytime there's an economy that has even a fractional reserve banking system, let alone central banks, fractional reserve banking systems that create these debt cycles, you have recessions and crashes and busts and depressions that are the result of all of the artificial expansion of the money supply reversing, causing this deflationary death spiral where money and wealth evaporates, disappears, the amount of money crashes, and the price of everything drops precipitously. Now, this sounds terrible, but it's actually the cure. This sounds like it would be very painful economically, but it's actually what lays the groundwork for strength and growth, real growth and prosperity moving forward. 1920 was the last time in America that we had an actual free market crash. The federal government did nothing to try and stop it, and in fact, they balanced their budgets, reduced their spending, and the Federal Reserve, in fact, raised interest rates. It was called the Great Depression until 1929, and at the time, the people talked about it as if it was the worst economic crisis that any of them had ever experienced. But guess what? With no intervention, no easy monetary policy, no lowering of interest rates, and no federal government interference, it healed itself within 18 months and paved the way for the Roaring '20s. There was economic pain. There was economic destruction, there was bankruptcy, and prices collapsed across the board. But number one, what that does is it clears out the deadwood. The companies who were not safe, the companies who were over leveraged, the companies who didn't have a savings account, they were crushed. They went bankrupt. They were destroyed. Assets went on sale, and people who did save, people who were conservative, people who weren't over leveraged, were able to buy things for very cheap. It hurts those who take too much risk, and it benefits those who were smart. Contrast that with the Depression that started 9 years later, when the Federal Reserve engaged in easing of monetary policy, and the federal government engaged in all sorts of ridiculous intervention that made the problems even worse most of the time, and made the economic pain last decades. And just in case you think there's a middle ground and you're thinking, hey, I get that what the Federal Reserve is doing right now by injecting a ton of new money into the system is causing inflation, and I get that if they completely reversed course and went all out and started selling off everything and reducing the money supply and sparked a deflationary death spiral, that would be, a short-term painful option. But isn't there some sort of middle ground where maybe they back off of the amount that they're printing and spending and buying assets, or maybe just reduce that to neutral? And unfortunately, the answer is no. And the reason why is that economies get addicted to monetary stimulus. Said another way, the amount of monetary stimulus that is happening becomes ineffective. And so in order to recreate the same effectiveness that you had last year or 2 years before, you have to multiply the amount of monetary stimulus. And so if you want to backtest this and say, okay, that would mean that if this is true, that would mean that we would have had to seen an exponential amount of monetary stimulus over the past couple of decades every time they've tried to deal with a crisis. Well, you look back and you can see absolutely, that's what's happening. The Federal Reserve's balance sheet is growing at an exponential pace. National debt is growing at an exponential pace. The total money supply is growing at an exponential pace. And the second test would be to see if that exponential growth of the intervention was also having equal results on the economy, or whether it was having declining results. And there you get the right answer as well, that the amount of monetary intervention, even though it's expanding exponentially, has a declining and a shrinking effect. And that's why we're not seeing the same result on GDP per dollar spent that we saw 10 years ago, 20 years ago, 30 years ago. And so if the Federal Reserve simply does nothing and they continue with their current pace of asset purchases, eventually it gets to the point where that is completely ineffective and you spark a deflationary death spiral simply by not expanding exponentially the amount of monetary stimulus. In order to just keep everything flatlined, you must exponentially increase, let alone keeping the stimulus the same, or withdrawing it completely, or even reversing course and selling. So they do have the tools to put a lid on inflation, but if they do, they risk sparking a deflationary death spiral, and that is something that the Federal Reserve does not want anything to do with, does not want on their hands whatsoever. And since it's basically a matter of pushing one button or another, it seems to me that the most likely outcome is they do not try to put any sort of a lid, any sort of downward pressure on any inflation that they see until it's much too late. If you liked the video, please hit that like and subscribe button. I really appreciate you guys. Thanks for watching. Have a good day.